We are live.
For live Senate appropriations, Thursday, April 22nd. We're gonna go through a couple of bills since we got the FY27 budget out. First, we're gonna go to the miscellaneous tax bill, H933. The GFO or Ledge Council want to go first?
Take over first.
Okay.
Afternoon, Senate Appropriations. RVP and Legislative Council. Talk about taxes. First, I'm going to connect. So I have a summary document, section by section, and also the bill itself. There's close to 70 sections. Do you have a preference, whether you want to walk through the summary or the bill?
Definitely the summary.
Okay.
So that's on here, SBS summary.
You sent the two documents, so I post them.
Did my joining Zoom show up for you?
No.
Which is a better document? The side by side, the APD.
The longer one is what I plan to walk through, that has all the sections. Side by side only has changes to Senate finance. But it's helpful if you do want to know only what's been changed in the Senate.
The side by side is 6 pages, the other one only is 3.
We're gonna go 6 pages for our purposes at the moment.
So, I'm sorry, which document?
It's all side by SBS.
Okay, so we are doing slides.
I think so. That's 6 pages. The other one will 3.
Yep.
Okay. All right.
But both them will finish this one. So this is good. Just get us oriented.
Still not coming up for me. I sent you a follow-up email and it link from my page to make sure.
There.
Did you get the cookies?
We did.
Okay. We should have.
Yeah.
Oh, these are.
We did.
These are. I know, when they.
Did show up?
And Amy made pumpkin with it.
Yeah. Well, me already. No.
I'm also not usually like you joined the wrong day or something. Like I sent the wrong day, you get an email. It's like, oh, someone's trying to join a Zoom. I didn't get that email.
Are you,
I have Chris through. Chris is able to get it.
Showing up?
No, like I said, it
Uh,
seemed like
It acted like I joined at one point.
sorry, you're not in my reading room.
or you can do it. Most of us have our laptop, so we can follow along.
Which one? Will you-
You go old school.
The one that has SBS side by side. Our thing.
Yes, there's so the document I'll be looking at is 6 pages. It is H933 miscellaneous tax bill section S section. Looking. So section 1 of H933. I'll try to flag for you, by the way, the Senate finance change that's together. So you can just assume that most of the stuff I'll be walking through is from the House, and further, most of the content of the bill came from requests from the Department of Taxes that are more of the housekeeping and administrative budget. So section 1 is a repeal of denial of tax credits for S corporations for taxes paid to other states. This was a cleanup request. Going back to the 90s, the Department of Taxes apparently lost a case involving this issue with an S corporation, and as what's been described by the department as a form of revenge. They asked the legislature to not allow credit for taxes paid to other states for S corporations, and they'd like to fix that now. Currently, other pass-through entities like partnerships and LLCs are allowed to do this. So making this change would allow S corporations that same treatment. Section 2 grants the department authority to investigate whether a bona fide or tenant relationship exists for purposes of applying higher property transfer tax rate. If you remember from a couple of sessions ago, there was a new higher rate added that was aimed at transfers of what would be second homes. Part of that relied on a landlord certificate as eliminating the properties that are going to be used for long-term rentals. And private practice attorneys in Vermont picked up on a pretty obvious loophole there, which was if you can set this up where you rent it to yourselves or to a family member, then you don't have to pay the higher rate. So this language gives the Department of Taxes the ability to kind of look through those sorts of transactions and apply the higher rate as specifically.
This is for the buyer, so the buyer has to provide a.
The buyer has to attest that it will be ripped out, and then one way to look at that is whether in the next year a landlord certificate was filed.
They don't have to do that at the time. Say what can be.
No, it would be his perspective or how it would be used in the next year. But in this case, the department could get a landlord certificate and say, wait, like
Right.
Bill Smith Holding Company is renting to Bill Smith.
Yeah.
Let's take a look at this.
Right.
So section 3 and 4 would have keep some person situation with current use where if a portion of a parcel being developed, there was a resolution years ago at this point that was worked out where it was changed so that when a portion of a parcel is enrolled in current use is unenrolled, the valuation for purposes of calculating land use change tax is done by valuing that portion that's either developed or being enrolled by itself as its own parcel. So that requires extra work for the assessing officials, and some municipalities don't have the capacity to do that very quickly. Some occurrences of taxpayers trying to own full land or they develop land and they're waiting to know how much land exchange tax they owe, but the municipality is just not able to do the assessment. So the changes in sections 3 and 4. If 30 days has passed, PDR can step in and do the evaluation themselves. There's also language there saying that if PDR does that, then the process for the municipality to get a cut of the tax money doesn't happen because they didn't do the work. So that's basically that. With the intent of trying to speed the process up for taxpayers so that you know how much tax to sooner. Sections 4A through 4C were things that were added by sinking finance. The first one, and all three of these came at the request of the department while the bill was. 4A changes one of the statutes relating to current use by changing it from when it comes to a forest management plan that has to be submitted every year. Under current law, the department's interpretation is it's written in a way that requires, if there are multiple owners, that every owner needs to sign that forest management plan. So this change, clarifies that one owner can sign the forest management plan, and it also adds some language saying that a forester on behalf of the owner can sign the forest management plan. So that's the change. In 4B, there's a change for when a third party is filing an objection to a property valuation appeal. There's a process for that under current law, and 14 days is given for that objection to be made. This extends it to 30 days. PBR had testified that because of the mail being slower these days and other reasons, that sometimes the window closes before people get much of a chance. So this just opens that window wider. 4C repeals a section in Act 73 that relates to some changes to the grand list of contents. We'll cover this in section 20 later, but basically that language from Act 73 is being replaced here. It has nothing to do with the ed reforms things and Act 73. It has to do with data collection for the purpose of the state doing mapping. That language is improved upon in section 20 here, so the department asked to repeal that other section. Just as a note, the ed reform bill that's making its way through the House also repeals this section because it's known that it's going to be replaced, or extensions are going to be replaced. Section 5 changes the calculation for payment to municipalities for municipal property taxes lost due to flooded or flood-prone properties. This change is for that municipal stabilization program that was recently created. There's a calculation for reimbursing the towns under the law as it's written. So it would be use the current year's tax rates to do that. And that becomes administratively difficult. So the change here would use the previous year's tax rates, which makes it in line with like other similar compositions of the law. But I think just Section 6 adds provisions addressing cases where a communication service provider failed to suspend inventory to PDR for property valuation. This is also housekeeping related to a recent change. In the last few sessions, there's been a transition from what was the telephone personal property tax to having PDR value communications property and having it taxed through the property tax system. When that transition was made in statute, the provisions that exist for municipalities to apply penalties for taxpayers who don't are playing along and spending inventories. So there's language here adding those same penalties, and it's penalty of $100 for not complying. Another change that was made in this section was made in Senate Finance, clarifying on top of the law is pretty clear, but expressly clarifying that one-way broadcasters like one-way radio and one-way television communications are not to be valued using this methodology.
Our value using some other methodology.
Yeah, the current law. There was never an intention for this. This is meant for two-way communication, like telephone. There was never any intention for a radio to fall under the same. Cell towers, I think, do fall under communication. This came up in Senate Finance because PDR is in the midst of starting its first inventories to start taking on this work, and they sent letters to some broadcasters. And I think that they sent those letters out trying to just kind of find out the lay of the land. And those broadcasters did not respond very well to being told that they might be caught up in something that they thought they were not caught up in, and attorneys told them that they did not apply to them. So a bit of a misunderstanding. PDR did testify that they would be willing for those inventories they sent out to accept inventory stating, we don't have this property. So that's my understanding, is that even if PDR sent out a request for an inventory, that a taxpayer could respond to that with, we don't have this property. They wouldn't have to inventory all their equipment just to prove that. But that is why Senate Finance came to that clarification. Section 7 clarifies the treatment of CHIP sites to be the same as TIF districts for purposes of the equalization study. This is just when CHIP was created. There wasn't any change to the equalization study and how that's to be done when you talk to the CHIP. So this is clarifying that when PBR does the equalization study, they'll do CHIP the same thing for the property value. Section 8 is for purposes of the equalization study, it requires PBR to use 100% of the CLA when determining tax rates for municipalities that doesn't do the master appraisal. Current law, there's a formula that PBR has to use for those municipalities. So let's say your municipality just did a master appraisal. You might logically think that that means my CLA will be 100 because it was just redone. But actually, the professional formula that can result in something other than 100, even though there was a fresh master appraisal. So this is just changing it so that it is always 100.
That's like in that year, everything like just. When they say that just completed, does that mean it has to be completed in that year?
In the previous year. Sections 9 and 10 extend the health IT fund sunset for 5 more years to 2031. Sections 11 through 14 go into education finance chapters and make some technical changes, changing inflators that are used in various places for education finance. It changes the references from the NEEP inflator to NIPA. NEEP is an inflator that no longer exists, and practically speaking, NIPA is already being used for that as replacement. Section 15 allows the property tax credit to be calculated using 100% of the property tax liability of the party to a separation or divorce who's living in the homestead, even if the other party is still an owner. This was the only request this year that came from the taxpayer advocate Department of Taxes. Under current law, if someone's going through a divorce, that means one of the parties is maybe living in the homestead, one of the parties is living somewhere else. The way that that's calculated under our law is that only 50% of the credit would be available for the person living there because one of the owners is not there. I think this was originally set up is where there were multiple owners, but only one. Yeah. So in these cases, taxpayer advocate said that they'll fix it. They have a mechanism to fix it. But they suggested, why don't you just change the law rather than be having to fix the existing companies. Section 16 aligns the estate tax filing threshold with the tax liability threshold, so the taxpayer shall require to return when the tax is due. Under current law, a taxpayer has to submit an estate tax return. I think the threshold is at 2 million value of estate filed, but there's no tax liability if the estate's worth less than 5 million. So the department has asked, we would rather not receive so many returns that have no estate tax due because there's nothing we can do with it and it's just something to process. I think originally that was created to give the department the chance to look into estates when they think that there might be a problem. But the department has said, we're not doing that, and these zero returns are just on taxpayers. Section 17 extends the down payment assistance program to 2031, and it also increases the maximum total award amount for the first year credit allocations from 250,000 to 350,000. So you may be familiar with the down payment assistance program, something that exists. The credits are awarded to a taxpayer, and then it's spread across 5 years. And there was a request from Department of what was that housing? DHF, DHF, Vermont Housing. So they requested change and the housing rate. Sorry about all of that. Sections 18 and 19 deal with a new federal tax credit that was created by HR 1 last summer, the big tax bill, the big federal tax bill. That law created a tax credit of up to $1,700 per individual for contributions made to scholarship granting organizations. Part of that program and the participation of that program relies on each state identifying the scholarship granting organizations within the state and submitting it to the U.S. Secretary of Treasury. If a state does not identify any SGOs, then there would be none for that state, which means that taxpayers would not be able to take a credit for contributing to any organization within the state. If Vermont did not send the list, Vermonters could still contribute to an SGO in another state and take the federal tax credit. But a lot of the state decision making around this is about whether Vermont will participate and whether Vermont will add additional requirements beyond the federal requirements for what an SGO has to do. There's been a few iterations of this throughout the session. It started with House Ways and Means saying Vermont's just not going to participate. One of the concerns they had was that even though this federal law is passed, it's gonna come into effect in 2027. There's a mandate, the IRS, adopts some rules for this, and those IRS regulations are not in existence yet. So partly like the landscape wasn't known, like one open question is, will those IRS regulations prevent states from limiting this program any further? So does Vermont have the power to say, you know, we'll allow this, but we're only gonna recognize SGOs that focus certain types of students or students attending certain types of schools. And so that's kind of still an open question until the IRS dump those regulations, which probably not going to happen until later this year. So Ways and Means said we're not going to participate. Then there was a floor amendment in the House that was accepted, that passed, that changed it to Vermont could participate, but it's going to be through legislative enactments. And every year, the legislature will pass a bill naming the SGOs and deciding what to do on. So it's the legislature giving itself the power to determine that, because the default would be that the governor would list the SGOs for this. So that passed the House, came to Senate Finance. The Department of Taxes testified that they would like it changed. The Senate did have an existing bill proposed on this, an S-312 from Senator Baumgart's that was passed out of Senate Education that would keep the SGO appointment authority with the governor, but place a few extra requirements on SGOs for them to be recognized in Vermont. Senate Finance took that version and put it in the amendment that you have. And also Senate Finance added a lot of reporting requirements and some extra requirements on top of what Senate Education done. In addition to that, they added a provision trying to address the House's concern about the IRS regulations. So the version before you also has a provision stating that if the Attorney General's office will be charged with following this at the federal level, and if there's a federal enactment, federal regulation, or a judicial decision that invalidates any provision of the Vermont statute, then Vermont won't participate until the General Assembly amends the statute and corrects it. So the idea is that if IRS regulations say, no, Vermont, you cannot tailor this the way you do, then it means that temporarily these Vermont will not participate and not simply list. So that's the you have. Okay, sections 21 through 23 were a change that was made in Ways and Means, and these sections haven't been changed since then. This limits the Department of Fish and Wildlife's fee setting authority for licenses, tuition for certain uses, and it prohibits the license for public access. It also repeals the department's regulation regarding fees for use of department lands and properties. That repeal would be next year, though. So under this language, the fees that exist under department regulation will be repealed next summer. Between now and then, the department will report back to the General Assembly for suggested fees for access to their lands. And the General Assembly will put those fees in the statute. So we're moving away from the department having fee setting authority to the legislature having that fee setting authority.
I have questions. I have questions.
No, well. Well, I have a good question. Are we gonna be? Like, is now the time, or do you think that we're gonna be talking more about each one of these sections?
Well, we gotta talk about sections again if they come up in fiscal year. So if you want to talk about it now.
Okay. Well, in that case, so that what you're just describing, as I'm reading here, is broader than what I had understood, because so I just want to make sure that I'm understanding. It repeals all of their ability. I guess that is something I had thought about. So it removes all of their ability to set fees. So any fee that they have that is not in statute otherwise, unless we act, is going away. Like they would not be even charged. Everything would become free if we didn't act.
between now and the end of next session, you have to have. And, yeah, it's just the fees for, like, the regulation on this, I wouldn't say is enormous or anything. It's for certain properties that there are certain fees associated with access to these properties. Mike O'Grady is the better person to talk in depth about these things, because this is certainly his area. My understanding is this partly came out of a desire for the department to charge access fees for things like kayaking and things that are other than hunting or fishing or something. And that's why.
We took testimony on that,
Yeah.
but what we didn't take testimony on is any, what other fees that they have.
Right.
Within that.
And I'm also interested in that in the description includes the word tuition, so presumably that's like, you know,
Green Mountain Conservation Camps.
okay,
Yes,
so.
And the deputy secretary of ANR did come by and say, they understand they lost the argument in finance about the water access fee, but they didn't want it to be for all of their authority. And as do other agencies have this authority?
Parks and Rec is really the only significant one.
They do have, they can.
They have similar fee setting for but yeah, earlier in the session, I looked at this and there are some other places where departments, agencies have a little bit of leeway in determining fees, but not to this extent. I think it's Parks and Rec, it's definitely comparable.
Right.
so do you know when they went in,
Report.
so in the bill itself. What was in the bill itself? Was it a recommendation to remove all fees, or was this added? These sections were added in finance,
House rate.
so house paid means.
It came from Ways and Means. Finance did consider changing this, and there was testimony.
Okay, you can-
And so finance ended up deciding on just to leave it the House version.
and it was all about putting a sticker on canoes and kayaks when they use the fishing access ramps. And so they've taken away all their authority as a result of that. Sorry,
Yeah, that's basic.
doesn't make all of the sense to me. Either way.
Yeah, so,
Yeah, I feel the same way. What if anything, are we doing in here about this stuff? And or did we change anything?
yeah, you guys want to take that provision up?
I'd love to take that.
We could ask, we could entertain the amendment that in our proposing that would limit the repeal just to the access. Right. Just so they keep their authority for whatever else it is that they have fees on.
Question about that. If we took that out, we had, that they can't charge anything for the ramps for non fishing or without a license. That would not allow for them to put a sticker on canoes and kayaks that use the ramps.
We put the money in the budget as if they were not going to be able to charge them.
That's okay, but why would we just tell them they can't do it in the future?
Well, it's good. I would say it's not appropriation. It's more of a policy.
It is
Question. Did you guys have this?
We did talk
have this
about
issue.
this, and there were some strong opinions, diverging directions, and so the thought was that the language that we were looking at now was talked about as was a compromise to do the report and come back to tell us about the fees that they want. But
Is there a report language in the?
Yes.
okay.
I was trying to make, I was making another attempt right now. Drawing.
Have you ever seen the language that I'm talking about from A&R? About,
I'm aware of it. My understanding of the language from A&R is one of the main goals of that seems to be to avoid a situation where their regulations get repealed and then they have to make new ones. And so it helps them skip the administrative rules process. But yeah, and then the general assembly can do whatever it wants.
I could see that, like, the thing that people had a problem with was charging for the ramp access. And it does seem that this removing of their ability to set fees is some quite a bit broader than what has to do with fishing access. And if that's where the conundrum lies, I'm happy to, try to limit it to that. But
I guess another option is that your committee would do a committee proposal on the floor saying your understanding was it was going to be limited to the one issue that for the boat ramps, and then you don't support a wider.
yeah,
That's not a bad idea, but there are, I can't speak for other people. Personally, I have problems with the whole concept.
Right.
And for many reasons, and I don't know if we want to get into those today right now, but those access areas, they're paid for with Nichols Johnson, Edmund Robertson monies specifically for those uses, and that's why they're trying to capture the people that aren't paying. And I get that. I'm in favor of that. So the whole thing, the whole concept, I'd like to, but certainly the second part where they're taking away future.
And I guess it gets into some policy of Fish and Wildlife, which we would have to take testimony on Fish and Wildlife. Right? So I'd rather have a committee of jurisdiction to get up.
get this on our agenda.
And I would prefer to micrograding or provide much deeper detail than I can do.
There could be other amendments that further change. Because we're originally from the money point, we were like, we would rather than charge the fees, then we go back to general funds. I'm not doing that. Okay, so
So I'll report back on how that goes.
you'll assume we'll have kind of a pile of the bills on the floor. We'll have the budget, the miscellaneous tax bill, the yield bill. I don't know what order they're all in. You'll have some time.
Sorry.
Yeah.
Not a huge amount. Not huge,
I gotta keep you at least one.
because all of them need to move relatively.
Yeah.
So instead of us holding enough credit schedule testimony, we'll look for a floor discussion. Did you ever have the delegate committee, or you just that issue?
No, we talked about it, as a part of our budget, letter, but then we decided to not include anything about it in the letter, just let it stand.
Right.
As us.
So I think it's appropriate to talk about it on the floor, since you didn't have it in your committee.
Yeah.
But
So have you looked, has your committee looked at the language, or will you look at the language?
We have not looked at
Fish and Wildlife.
We had, the commissioner is to talk about it as a concept.
before this.
Before all this stuff.
No,
Before
it was
finance.
it was actually after finance. Yeah. Or,
Or why they.
right, it was after they had discussed it. So we have not actually looked at language in.
Can I just ask if this is scuttlebutt or true? Somebody told me that there was a reason to collect fees for bird watchers.
No,
No, so that was,
That's.
in the rollout of this idea, it got, I think that was how it was characterized, and that's not accurate.
Okay.
look, you're standing on the boat launch, looking at a bird, by getting in your kayak, they could say,
You have to pay $3.
You need a sticker.
Yeah.
yes, there
The
was,
state, it's another. In the flip changing of rules, it's another thing where
that people do this all the time. They kick the general fund around because we end up holding everybody's back. And, so from that point of view, I would argue that this really is one of those things that it's happening all the time.
The 50,000 that we backfilled was one time.
We did it one time since we knew that was in the bill and we didn't know it was, so we thought it's better to backfill it, but that would be extra money we'd have at the bottom line later. If we change this policy.
Well, I'm worried about the future too.
Yeah, right after the bottom. It should. Okay, this is.
Okay, moving on.
Going forth to conclusion.
Yes, we've got a big chunk that we can take care of real quick. There's section 24 through 48 are conforming changes that remove the grand list submission date from April 1 to January 1. This is to happen kind of in line with the regional assessment districts concept that's happening with the reform bill. The idea is that having the grand list submitted as of January 1 instead of April 1 will give more time for the appeals process and other things to take place. Sort of gives more breathing room to that, to the whole property evaluation process. So again, that would not happen until a few years from now. Section 49 removes the statutory language empowering the director of PBR to supervise the collection of delinquent taxes by municipalities. This is some holdover provisions from when PBR was its own department essentially and had other duties. So the department testified that PBR's not really doing this and we'd like to statutes that's be removed. Sections 50 through 53 were some sections related to taking the fees, or not the fees, but the expenses that are being paid for right now out of the general fund for EBR to reimburse municipalities for different costs related to maintaining the grand list and helping with the equalization study, to having that paid for out of the final special fund. There were some members who were not big fans of that on the House floor, and there was an amendment to remove those sections, and that passed. So those sections are gone. There's no touching of the pilot special fund or PBR related expenses. Section 54 is a study, a 10-year study on Vermont taxes to be conducted by JFO. It's an appropriation of $100,000 for that study. If you have questions about all that JFO will study, I'll leave it to them.
So I thought it said you do it every year, but it's, or you do it every 10 years.
Every 10 years, they do it. Not to be confused with, Blue Ribbon Tax Commission and things like that. This is a different study that's done by staff. Section 55 is a very big part of the bill. It is the primary place where Vermont would be decoupling from some areas of federal law that at least impartially relate to the changes that were done to federal income tax laws last summer for HR 1. One of the changes is to decouple from federal treatment for bonus depreciation on qualified production property. The HR 1 changed some things so that non-residential properties that are used for like agricultural factories and chemical factories the owners could depreciate the value of those as a deduction and do it all in 1 year. Usually for real property like that, it would be depreciated across 39 years on their federal taxes. So this change allows for, that's what bonus depreciation means, is to be able to do it all at once. And that was going to be something that does flow through to Vermont. and have a revenue impact here. So, Ways and Means thought that we should decouple from that one. As
Tax year 25, tax year from this.
this is all of these changes are designed to, not have a gap between when they take effect federally and when they would hit Vermont. Where we link up to tax year 25. So all of these decoupling changes as written would link up at best in the same budget.
25.
Yes, that's the link up is to 25. So that's one change. Oh, I do want to step back though, and when talking about this, remind you that there were over 100 tax sections in HR 1, many changes made. And that's not counting the energy credit sections, which also just has. So I'm talking about the things that are being decoupled from in response, but and there's a handful of those things. Everything else that was changed at the federal level, Vermont is coupling to here, and so that might not be immediately obvious. So to help with the context, these are the few things that the decision was made that Vermont will not have flow through on the Vermont income taxes. So that's one. Second is there's a federal deduction for domestic research and experimental procedures. The change that was made, so there was a change made in this area under the Tax Cuts and Jobs Act, where those domestic, there's domestic and there's foreign deduction for each of those categories of expenditures for research and experimental procedures. HR 1 or Tax Cuts and Jobs Act, I'll say first, changed it so that those expenses on returns had to be amortized over 5 years for domestic. For foreign, they're actually 15. HR 1 has changed it back to how it was before, where those expenses can be fully deducted in the year in which there was the cost. And that was something that would flow through to Vermont. So the House solution, so to speak, was for smaller businesses, and this is using federal definitions, a business that has 31 million in assets or less, basically Vermont will continue to be coupled for that. But for businesses larger than that, they would have to continue to amortize the method research experimental procedures over 5 years. And there was a lot of drafting in here, a lot of probably some of the most legalese we now have in all of our statutes, because we had to take into account what happens when a business goes from small to large, large to small. There was also a part of this where, so for the past few years, they've had to amortize. Well, what do we do about that? Because the feds were going to allow the small business, 31 million assets, small businesses, they were going to let them catch up all at once. And in the first year, take all the expenses for even the previous years that they hadn't gotten to take yet. So there's a lot of language in here to account for all of those possibilities, including some changes that were made in Senate Finance, because for at least one or two type of issues we had to add some clarifying language. That's what came out of the House. After our work from the tax department, we decided that we needed even more clarification. So that's what the overall approach is, though, which you have on that. There's federal deductions for foreign sourced income. So at the federal level, under Tax Cuts and Jobs Act, before Tax Cuts and Jobs Act, I'll say that when it came to certain types of income that were from foreign controlled corporations, like corporations that exist in another country, but most of the ownership is actual like domestic taxpayers here in the US. It used to be that basically the income that came out of those that type of business would get taxed when that money comes back to the US, if it ever does. And one of the problems was that the Tax Cuts and Jobs Act tried to address was through a lot of tricks, we'll say, that money could perpetually just stay. outside the US, outside the US's reach. So Tax Cuts and Jobs Act made changes and started taxing basically a new type of income. And something there's guilty, there's something called FTDI.
We don't need to know all.
You don't need to know all that. You don't need to know all that.
It's scary what you're saying.
Uh,
All this money going out of the United States when that was.
it's stuff like
Not just
you
Vermont.
could take intellectual property, for instance, and you could put it in a corporation that's in another country. And then the income from that intellectual property starts to be sourced to that country. And so, yeah. And there was an element of this where intangible property was an issue. So the first iteration of Tax Cuts and Jobs Act, I promise I'm gonna try this before it's possible. But the first iteration of it tried to pretend to get at that intellectual property through some like kind of proxy math. They stopped pretending with HR1 that this was only about intangible property. And so the math relating to that was changed. There were a lot of changes. Long story short, under HR1, with this type of income, they changed some of the deductions that were available because there is some recognition that some of this income is actually legitimately foreign. So they changed some of the calculations so the deductions were not as generous as they've been, but there's a tax credit for taxes paid to another country that was increased federally. Well, for Vermont, the deduction part of it would have flown through, and it would have meant a slight increase in revenue for Vermont because of that. And the tax credit, though, part that's available federally does not flow through. When Ways and Means looked at all of this, they thought the reason these deductions that do exist for this type of income, they exist out of recognizing federal level, at least partially, that not all of this is U.S. income. So we're going to allow some deductions. What your bill does here, what your language does, is Vermont does not allow those deductions at all anymore. So it's not a direct response to what was happening in HR1. It was more of a taking a look at the whole picture and saying, we in Vermont, we have single sales factor apportionment when it comes to corporate income taxes. And that means that we do already have a process to try to narrow down what part of this income is Vermont income based on sales into Vermont, using Vermont as a market. So allowing a deduction to try to separate out what's US, what's foreign isn't necessary was the logic. The logic was we are going to let our apportionment sort it out, and we're not going to allow these deductions anymore. And so that's what the language says that you have. And JFO has the numbers on it, but this is one of the changes that creates the most revenue, so to speak. These changes. Okay.
Sounds good.
I talked long enough that my computer went on. Okay.
Section 58.
Last one. Aside from there's a lot of clarifying provisions and a lot of drafting stuff in here, but the last big policy change was it's only for personal income taxes because this is something that only relates to personal income taxes. But at the federal level, there's something called qualified small business stock that going back more than 10 years, the federal level, there's an exclusion that exists for gains from something called qualified small business stock. How this typically goes is there's a startup corporation that's just getting off the ground. They need investors, and then they can issue something called qualified small business stock to try to get that initial capital. The only corporations that can issue this stock before HR1, they had to have 50 million in assets or less. HR1 made several changes to expand this exclusion. One of them is to say that now we're going to consider them a small business to issue the stock if they have 75 million assets or less. But if you as an investor put money into this or given this stock at the federal level each year, you can sell the stock after if you held it for at least 5 years, you could sell it. And your gains would not be taxed at all up to 15 million in gains. And that's for each issuer. So if you're investing in several of these, then you could have more than that. That 15 million in gains was something that was increased by HR1. Before it was 10 million for that. So there's a lot of areas where it was expanded. So anyways, the language you have is saying, you know what, Vermont is going to actually, this exclusion has up until now been flowing through Vermont. But the language you have would decouple Vermont from the exclusion altogether and just say that taxpayers that have those gains, those are going to be treated like capital gains like anything else, and Vermont will tax those going forward.
Sounds good.
Sections 56, 57, add clarifying language, relating to, apportionment when it comes to, personal income tax. I know I'm getting long here, so I'm gonna give you the short version. The way that we do apportionment or corporate income tax has been updated recently, and it's in a pretty good place.
That's all we need to do.
Personal income tax, in contrast, has not been updated recently, and has not been updated as Vermont has decoupled in the personal income tax area. So the way that the statute's written, at least, is a bit nonsensical. There's language here that to correct that, to make it flow more like corporate. And just say that this change could affect situations in which a person is being taxed way too much, they have income outside of Vermont, or taxed way too little, because we're not taking everything into account that the rest of the law does. Then I'll just leave it at that. Section 58 changes the research and development tax credit from 27% of the federal credit to 75%.
When does this take?
This is 2 years out. So it does not immediately affect the budget for now. This was a way that we talked about some of that research and development changes in the research and development deduction area. And to put some of the money back towards research and development by putting it into this credit. This is the credit that's only for expenditures in Vermont, so it kind of focuses it there. But it increases the credit amount quite a lot, as you see, 27 to 75. The next section 59, just with the downtown and village center tax credit. The House version had increased the amount awarded annually for this credit by $1 million. Senate Finance moved that increase down to 500.
You were aware of that.
Section 60 and 61 is the annual link up. These are the sections that say everything we didn't decouple from before from HR1 will be your coupling to the entire federal code for all of the things that we haven't expressly taken out. And then section 62 and 63 changed some allocations of revenue. So 27% of the purchase and use tax revenue will be deposited in the education fund under this language. That's a change from 33% currently. 73% of purchase and use tax revenue is deposited in the transportation fund. So that's an increase from 66. 29% of meals and rooms tax revenue is deposited in the education fund, which is a change from 25. And then 65% of meals and rooms tax revenue is deposited in the general fund, change from 59. So it's moving.
Yeah, we know, but
You know, and moving.
And surprised people talk about this. I particularly hate the meals and rooms tax or the percentage going to the general.
Section 63A, were changes made in Senate Finance, or added in Senate Finance. There's language there that goes through the recent history of the Burlington waterfront tip, restates the law, stating that the city may retain 75% of the state tax increment and 100% of municipal tax increment. And there's also a section of 53B there, section law, saying that Burlington needs to submit an updated tax increment financing plan on November 15, 2029. The full intention of this is to just give the legislature's intent and to state the current situation, and it's all. Section 64 is your effective dates. I think one that you asked about was at the bottom, subdivision A. So the decoupling and the annual link up are all happening together. And they're retroactive to January 1, 2026 and apply to tax years beginning on and after January 2025. People who filed their taxes this year or filing for tax year 2025, this does affect that. For some of these things, it's possible that people owe more than what they thought they owed when they filed this year. The department will be responsible for conducting outreach to try to correct that. I don't think there's a lot of expectation that a lot of money is going to be found retroactively like that. But that is how it would work. And a lot, and that has to do with the way we, and how when Vermont responds to federal changes, it's on a lag because it's reactionary and our legislative session starts in January. And that's it, unless you have more questions.
No, I'm gonna move to the fiscal. Thank you, that was all.
I'm just gonna explain section 55 before.
Now ready for this.
Will be fun. Huh?
Are you gonna hold that fiscal note? Chris is big, but- You're gonna-
That's a good question.
Thanks.
All right, well, good afternoon, everyone. Chris Group from the Joint Fiscal Office. I will try to be brief and succinct when going to the fiscal note. And when we get into the weeds of the corporate taxes, Pat can answer any questions, on that because my eyes start glazing over at the very thought. What we typically do with miscellaneous tax bill is, focus the fiscal note on the sections that are particularly interesting or relevant from, a financial perspective. So that's what I'm going to do. I'm going to start though by just giving you the bottom line up front that the big bill that you all voted out reflects all of this. So there are no conflicts between the big bill that you just put forth and what's in this bill. They are harmonized. The one substantive change that the Senate Finance Committee made to the numbers relative to what came out of the House was on the downtown and village center tax credit by expanding it by $500,000 instead of in section 59. Otherwise, everything else is the same that came over from the other five. When you total up the impacts of all of the tax credit and policy changes and the one-time appropriation to JFO to do the 10-year tax study, everything nets out to the numbers at the very bottom of table 1. So you all accommodated the reduction of 3.96 million in FY26 and the up in FY27 by slightly adjusting the numbers and how much carried forward from FY26 into FY27. So you can see here that the transportation fund benefits from this to the tune of about $10 million as a result of that shift of the meals and rooms and then purchase and use tax. The education fund is essentially neutral on that. We'll get to it later on that walks through those numbers, but I'm just gonna fly through here. Feel free to jump in with any questions so I can stop prolong this any longer than we have to, because I know you're things to do. The next couple sections here just give a very high level section by section that gives you in 1 or 2 sentences an idea of what is going on in every section. And we'll leave a little breadcrumb here if there's, see description means that there's an elaboration further on.
A lot of the minimum.
Yeah, there's a lot of de minimis and a lot of just technical cleanup that really doesn't have an impact. I'm going to skip over some of these and really just focus on the ones that are most relevant to this committee. So sections 9 and 10 have to do with the health IT fund and the healthcare claims tax. I am bringing this up because similar language came over in the GovRec big bill language, where every few years the legislature extends the health IT fund and the claims tax that funds it. This year, that language is no longer in the big bill because it's in the miscellaneous tax bill. And the extension is for 5 years. So that just continues status quo. But I know given that some efforts here are also on health and welfare, you might find this interesting. And I wanted to make sure you knew where it lived. The down payment assistance tax credit is proposed to be extended for another period of time at a slightly higher rate of $350,000 in total first year credit allocations. Under current law, that was at $250,000. There is a great little diagram here that VHFA put together that we copied and pasted because it was brilliant and clear. You gave them a credit, but if you look at the green bar, it shows you what the additional impact of this proposal will be in future years. So that first year allocation carries forward for 5 years in each tranche. So you see that as credits roll on and then roll off, the impact of the change fluctuates a little bit over time, but starting in FY 27, that's additional $350,000 of foregone revenue, and that shifts a little bit over time. And then we talked about the fish and wildlife issue here. And you all, I just wanted to point out that your budget did backfill down to $50,000 in FY 27. The 10-year tax study, the last time we did that was approximately 9 years ago. This would be the fourth one that I have found that JFO has done. We found some going back to the 90s, and just to refresh the committee's memory, every 10 years we do a retrospective deep dive over our looking at what happened in the 10 years since the last study, and look at changes to our tax code, who bears the tax responsibility for our different taxes, how do we compare to other states, and we look at some other issues there. But it's a really helpful resource document that it's not like the tax commissions that have happened in the past. This is something that's staff driven, and it's a very big lift for our office. We often bring in some outside consulting expertise to help us with little pieces of that. So there's a $100,000 one-time appropriation to help us fund those.
Our tax expenditures part of it, or is it just?
It's not really part of it, but some of the things that we have done are we've hired accounting firms to run sample returns for like different family configurations and business structures. So we can sort of put hypotheticals together around who pays and what does our tax responsibility look like. We've also done some graphic design and editing work and things like that. And one of the focuses we're going to look at are, for this year, how do some of our tax credits and tax provisions at the state level interact with eligibility for benefit programs. So some of you have heard this concept of the benefits cliff. And rather than looking at every single program out there, we're going to look at significant programs and how our tax structure might exacerbate or mitigate any of those cliff issues. And are there recommendations that will come out of that work?
Why don't we look at tax expenditures?
Tax expenditures is a separate lift that we do every 2 years, but that I can see is.
Well, when you do that, but that's just listing, right? This and this more of like some analysis of the tax and like showing a comparison to other states and where the burden.
Yeah, do you want to jump in, Pat?
Yeah, so nothing Chris said is incorrect. But part of I'll just use an example. Part of the study will be looking at sales and use, for example. And part of that discussion will be looking at what the base for sales and use is. And of course, things like exemptions from sales and use tax are subtractions from the base that you're looking at. So it's not like an explicit study of tax expenditures, but there will be some exploration of it.
And we are doing the tax expenditure report again also this year too.
Right.
Yeah.
We do that every 2 years.
But that just kind of lists them. I wonder if we ever go through them all. And then you kind of, I guess that's the legislature stuff. Without looking at all the tax expenditures, whether we want to keep those going.
Yeah, I mean, we don't just list them, we also quantify them and give you all the statutory purposes, and then, yeah, it's up to you all to figure out whether they are still worth doing or not.
Okay.
Sections 55, 60, and 61 all relate to the federal link up and decoupling that Kirby gave you a exhaustive walkthrough of.
Not nearly.
Could have been more.
So much more.
There's some language around the R&D credit as well, but really I wanted to bring your attention down to this table here that summarizes all of the impacts of the tax policy provisions. So these roll up into that chart on the very, very front page, but this itemizes what each provision does and how far it moves the needle. So you see some downs and some ups. If you see a negative, that means it is we are foregoing revenue to the general fund. A positive is an increase. But when you look at all of it, it shakes out to about a little over $14 million to be good in 27. And when the impact of the R&D tax credit in section 58 hits in FY 28, the number comes down. And again, these numbers were all built into your budget spreadsheet. Do you have anything to?
Well, if I may, just to give you this committee a little context about why you really care about some of these provisions, why they matter to you. So we initially, in conjunction with the tax department, done analysis on the effects of HR1 that suggested it was going to be very muted. But after we gathered more information and we were able to update estimates, if you think about this chart in the fiscal year columns, assuming normal link up conformity with HR1, for fiscal year 26, we've been looking at a $21 million hole that was not accounted for in BAA. And then for fiscal year 27, that would have grown to about a $35 million hole that was not accounted for in the GovRec. And, was less money than was in the consensus forecast. So very much would have affected your work in the money available for building the budget.
Now that's important context. We've been talking a lot since HR1 passed in the summer about what impacts will flow through Vermont and what won't. And fortunately for us, most of the personal income tax provisions that you've heard a lot about in the news, like no tax on overtime and things like that, that does not flow through the Vermont because we start our return at linking to the federal definition of adjusted gross income. And all of those other provisions happen below the line after that's calculated. So states that link up to like federal taxable income instead are seeing revenue shortfalls because this is fast. But we are fortunate that we're not seeing that. With one of the few areas where we are seeing the personal provisions is in the child independent care tax credit because our credit is linked to a percentage of the federal credit. But your predecessors in the legislature were very helpful when they restructured the tax code to decouple considerably from the federal tax code rates to HEI. On the business side, we link to federal, net income, net taxable income there. So like a lot of these changes do end up flowing through. So that's why some actions need to be taken. So the last really substantive thing I wanted to talk about was the meals and rooms and purchase and use shift. Just to remind everybody, the GovRec had proposed transferring $10 million. Before I go down this route, let's keep the number $10 million here. $10 million is the number that needs to go into the transportation fund in FY 27 to make the GovRec work, as three of you know. The governor proposed getting that $10 million in by moving 10 million from the general fund to the ed fund, and then stepping down the amount of purchase and use tax that goes to the ed fund by $10 million a year. So that would effectively put 10 million additional into the T fund, give or take with some instead of the ed fund, and that would go out over 5 years at a $10 million phase down. Of course, that beginning in FY 28, when there's no explicit plan to backfill the ed fund, that creates a hole in the ed fund that, when all else is being equal, is filled through education property.
Or just the 10 million was just for the first year.
Correct. So what this construct does is gets you to $10 million by shifting the allocation of meals and rooms and purchase and use tax revenue. Nothing about the rate, nothing about the tax changes. It's just what major fund gets how much of the money. So 4% of the meals and rooms tax and 6 1/3% or so of purchase and use shakes out to about $10 million. So this proposal would make a roughly $10 million shift of revenues a permanent arrangement, not just a one-year deal until a future legislature decides to make a change in that policy. But where you see how the impacts of the major funds net out here is that the T fund is up roughly $10 million a year moving forward. The ed fund is essentially neutral. And the general fund loses what the ed fund gains from meals and rooms tax. So that's a $10.8 million loss beginning in FY 27. So that is a lot of verbiage to basically move the rough equivalent of $10 million worth of revenue from the general fund into the T fund.
So everyone,
Want me to complain now or later?
you can complain now.
I don't see why when we're in a time when very much could be on the edge of the downturn, most economists say someplace between 40 and 50% of all of the analysis says that we could be on the edge of a downturn. We've been moving money from the general fund, cash, over to the T fund to allow the T fund to put together a budget. Why would we do this whole construct of changing tax structures that is supporting the general fund, because the general fund is the loser here? Why would we change tax structure now when things aren't calm? The ed fund isn't calm because there's a huge fight over the ed fund. And the T fund is not calm. Why would we do that? Why is the general fund has the money when the general fund just transfer 10 million to the T fund to make it whole this year? Leave the taxes where they are and talk about a change in purchase and use starting next year. And that way you don't adjust the tax structure in a time where our country is on the edge of something. And we've been moving money from, no one has been able to put together a T-bill for the last 3 years without money coming from the general fund. So why would you change that? Why wouldn't you put maybe some next year you could make those adjustments but I see this as the wrong time to short the general fund in meals and rooms tax that is rightfully belongs in the general.
One issue is we're also moving general fund to the education fund every year because we don't have enough money in the education fund.
And we're doing that again this year, and we do that, we're doing that on a one-time basis this year. So why would we change our policy when, you know, if I was looking for and everything would have said, everything is rosy going forward, and it doesn't look like we're at the end, we're in the longest expansion in the history of the country. Fuel prices are up. And why would we, if we're gonna do one-time transfers over to the general fund, why wouldn't you treat the transportation fund the same way? And next year, as things begin to settle a little more and are thinking about everything, and we might have more information about the fund, then you could make a decision about whether you permanently want to send taxes from one fund to another. But for right now, just do the same thing we've been doing the last 3 years and make a permanent decision. I don't want to short. My view is the general fund takes care of poor people. And this place does not like to take care of poor people. We will not raise taxes to support the less fortunate in our society. We would raise taxes to alleviate the property tax, but we will never do it to take care of the worst of society.
So you want to just move 10 million from the ed fund to the transportation.
Yep.
And leave the education fund alone.
Yep.
And leave the B and U alone.
Yep, and leave the, and leave, or, you know, put it off the year, whatever you do, and the money that is in here that moves, I most object to the meals and rooms tax and adjusting that tax away from the general.
The issue that this would bring up is that we would now be changing taxes that were set by tax. set it up if you want to.
Well, I would say to that, the effect of everything they do lands right in our budgets.
And I would say that since the general fund is the loser, it's fair game for us to talk about it because it's essentially affect our ability.
And it's not only affecting our ability to appropriate now, it goes on forever.
Right.
Or shall we change it?
It keeps happening.
And it keeps happening, and if the economy goes down, we're gonna be in trouble.
Mr. Chair, I'm not sure what the timeline is in your thinking for this bill, but it seems like a chair to chair discussion. That this would be on that section.
I mean, plan was to see if we could vote it out today. I don't know how important that is to get it up.
I don't think it is myself, especially because of the situation on the budget.
How do other committee members feel about wading into this acquisition?
I think it's a good idea. Eleanor.
Have an opinion on this, Norris? Well, I'm going to team. Okay. All right, well, I will talk to the chair. He would come to that. Okay, I think we went through all the fiscal impacts.
Yeah, the rest of it's just some language explaining what the verbiage around the Burlington Waterfront diff is, but there's no fiscal impact associated with it.
Burlington, Schmerlin.
Or TIF.
Never ending.
Never ending tip.
Okay. Thank you, and we'll come back to 9:33. We were gonna pick up 9:40, but Alan is like fitting us in between many different things, so we think you're around at 3.
Right, great.
Okay, so we'll have a quick 15 minutes at 3 o'clock. Try to vote out 9. Okay, well, at 3 o'clock. No, 9:47. Bill coming out of, yeah, that's a bill coming out of.
We have to commit right at 9:40.
We're meeting at 9:40.